By best estimates, we're about 200 days away from Bitcoin's halving. Bitcoin is currently under $30,000, and it seems to have started a nice rally since November 2022. So people are getting excited because the halving is approaching. That's when the number of Bitcoins produced by the protocol for each block to reward miners is cut in half. Historically, halving day kind of kicks off the party because it's typically the start of a bull market phase. You can see this trend on the chart. Every 4 years, right around the halving, the king of crypto sees its price shoot up. Look at how precise the timing is. It's like Swiss watchmaking. But here's the thing, if Bitcoin's price was truly so predictable, the market would have accounted for these cycles by now. In other words, the price of Bitcoin would be more stable over time because if there's one thing markets are good at, it's forecasting. To put it plainly, financial markets constantly adjust their future expectations in real time. And despite what some might say, when you're dealing with assets with high trading volumes, they're incredibly efficient. So while halvings do put upward pressure on the price because they reduce the supply of Bitcoins, does that mean halvings don't actually predict anything? I think that might be the case. But then, does this mean the next bull market won't happen? We'll discuss that. In the past, you could argue that Bitcoin was a small, niche market that didn't attract enough savvy investors to be efficiently traded. But now, billions of dollars are exchanged daily with a total market cap of $500 billion. We're not talking small change anymore. Hey guys, GA Crypto team is back. Samantha here and excited to give you yet another info-packed video to get everyone on board and up to speed about the crypto revolution. Today's topic is quite exciting. So let's set the stage. First, why do most people believe the halving will drive up the price of Bitcoin? The reasoning is pretty straightforward. Given that the price is determined by supply and demand, if we assume demand remains stable and supply suddenly gets cut in half, then the price should go up. In Bitcoin's case, its demand is increasing, and in fact, the issuance of Bitcoin decreases every 4 years when the number of Bitcoins issued is halved. These few lines are a quick summary of the theory called stock to flow, which basically refers to the ratio between the total stock of something scarce and its production rate. Typically, gold has a stock to flow ratio that allows it to gain value over time. The issue with this theory, as solid as it might seem, is that it doesn't explain why Bitcoin has value. It merely describes how its price can evolve if, and this is a significant assumption, one accepts the basic premise that it's Bitcoin's scarcity mechanism that gives its value. But there are plenty of rare things in metals, like palladium, for instance, and just because something is scarce doesn't automatically give it value. The rocks in my backyard are rare, but nobody cares about them. In fact, if we look back at the famous debate between Plato and Socrates on the nature of money, neither of them mentioned scarcity as the fundamental value component. Both agree that humanity needs currency to address practical issues related to matching the needs and consequently need something easy to use for this purpose. If a currency is to be accepted, it must have intrinsic value. Otherwise, people won't want it because they're not sure if they can pass it on. And here's where Aristotle's and Socrates' logic diverge. For Aristotle, only a commodity useful to many can serve as money, like salt, arrowheads, and so on. You know the drill. To him, using a commodity as money is the surest way to ensure that the currency has value. And that's actually smart. But if your money is salt and suddenly everyone starts favoring sweet taste, your stash of salt in the attic loses its value. And then your currency also loses its value. Tough luck. So Socrates, seeing Aristotle's predicament, explained in writings about a century later that to address this materialistic issue, the value of money should be conventionally decided. And just like that, we created a currency by stamping numbers on metal pieces, saying it's worth what's written on it. To uphold this convention, it's decided that anyone caught tampering with the currency will be executed. Problem solved. In principle, this isn't a bad idea either. You delegate this power to the reigning king, and you introduce what we call fiat currency. No issues, as fiat currencies have been in use for thousands of years. But even in this scenario, there's a lingering issue. Sometimes the king becomes greedy, tampering with coins and breaking promises by choice. Thus, gold enthusiasts and Bitcoiners alike, in sheer delight, watch Aristotle mock Socrates as he plunges out of sight. So where are we today? Both have their points, but they serve different purposes. For me, it's essential to distinguish between a currency's features and its core value. This tale of the three roles of money doesn't clarify its value origin. But if you believe gold is the best form of physical money we have, then you grasp why it's so cherished. Hold on a sec. Gold may be beautiful and possesses unique physical properties, but why is it seen as the unbeatable currency? What is it representative of? At its core, the ultimate commodity for humanity is energy. Energy has always been the driving force behind wealth creation. But here's the thing, energy is hard to bottle up, let alone turn it into coins. However, given the energy needed to mine gold, its rarity, and its non-corrosive nature, maybe it can represent energy. We know energy was spent producing it, so it's not literal energy. You can't harness the energy used to mine gold by burning it, but if we accept it as a good stand-in, it works. That's why it's often said that gold is in fact a form of debt, a collective one. It reflects humanity's energy debt. When someone gives me gold equivalent to a kilowatt of energy, I know I won't get that kilowatt back by burning it. So when I trade a chicken that produces eggs and meat for gold, I'm trading real energy for a symbolic energy debt based on gold's energetic past. It's an energy debt. Now, let's talk about Bitcoin. If you see Bitcoin as a tool reflecting proof of energy-based work, you understand it's rivaling gold as an energy debt currency. So, Bitcoin aims to replace gold, not fiat currencies, which are based on societal agreement. But what does this have to do with Bitcoin's halving and its value? Bitcoin's value isn't about halvings. Everyone's known the Bitcoin circulation since 2009. Why would its price spike in cycles when we all see it coming? It's like being startled watching the same horror movie for the 6th time. However, as Bitcoin continues to prove itself as a gold rival, it gains more acceptance. If you consider gold's value trends, adjusting for Bitcoin adoption, there's a foundational explanation. As for gold, its global adoption is pretty much complete. Its price fluctuates inversely with fiat currency values, balancing the monetary system. Let's simplify this. Here's a chart that'll blow your mind. In black, you have cash, or the value of the dollar, gold in yellow, and oil prices in orange, spanning 120 years to see long-term trends. What's clear from this chart is that over this time frame, energy, gold, and the dollar have preserved value in sync. This consistency can't be pure coincidence, especially considering the value shifts between 1910 and 2020. What a twist of fate. So no, the dollar hasn't devalued against gold, and gold hasn't outperformed energy. But by now, you get it. The ultimate currency is energy, and humanity's quest is to find the best representation for transactions. All right, now you might be wondering, hold up, the dollar hasn't lost value against gold? I remember in 1920, with $100, I could get 150 grams of gold. And now for the same $100, I can barely get 2 grams. Sounds like a value loss, right? But here's the thing, to offset the dollar's decreasing value, the US Federal Reserve had to adjust its federal funds rate throughout history. Now, if you factor in this interest rate to the dollar's value from 1910 onward, boom, you'll see that the dollar didn't actually lose value against gold or energy for that matter. Hear me out, it's undeniable. Now, I can already hear some of you saying, wait a minute, she's mixing up the dollar's value with dollar investments. Keeping money in the Federal Reserve to get an interest rate is an investment. Look, if we're comparing gold to Bitcoin, investing in mining in both scenarios means taking on an industrial risk. So yeah, you can't compare gold and gold mining investments. They carry different risks. That's intrinsic to the proof of work concept. However, if you consider Ethereum and its proof of stake mechanism, there's no more risk-taking for your ethers on an Ethereum node than keeping them in your wallet. And for the crypto enthusiasts out there, let's not get nitpicky with slashing penalties meant to deter bad actors. It's not a market reward for risk-taking. Similarly, with dollars at the Fed, it's the same deal. Depositing dollars with the Fed is like staking them on their blockchain. So, a fully valued ether is a staked ether, just at a dollar's full value is when it's deposited with the Fed. In finance, when you're crunching yield numbers and comparing them to the dollar, you always look at excess returns, for example, dollars with their short-term Federal Reserve yield. This brings me back to our early discussion about Aristotle and Socrates. Proof of work or proof of stake, both are methods to manage currency, so its value aligns with that of energy. Hence, it makes sense that the market balances these two values, both centered on energy. That's precisely why when fiat currencies lose value, markets demand higher interest rates to make up for the loss. Again, in the long run, two currencies maintain the same value. Take the dollar and the Swiss franc, for example. The Swiss franc has been appreciating against the dollar steadily since the end of World War II. But to balance out the value, interest rates are higher in the US than in Switzerland. And so, when we look at the long run, 100 Swiss francs invested in the Swiss National Bank yield the same return as $100 deposited with the Fed. The market determines the value. However, gold plays by a different rule, since it operates on a proof-of-work principle. So you can't stake gold in mining without taking on the industrial risk of the gold mine. Therefore, gold's value fluctuates in relation to the dollar you have in your wallet, not the dollar staked with the Fed. This is where it gets very interesting. Observing monetary expansion phases where the dollar's face value drops while gold retains its value. And then, you'll notice that gold price movements are inversely proportional to the amount of currency in circulation. This graph illustrates that gold prices surge during what Didier Darcet refers to as the Keynesian periods, essentially when there's monetary debasement. Therefore, market surprises that lead to gold bull runs should be attributed to monetary expansion phases, combined with Bitcoin catching up to gold in market share. Now, if we overlay the dollar's monetary expansion phases with Bitcoin's price trend, well, it's a perfect match. The phases we often call monetary debasement, or the Fed goes brrr, for those in the know, align with Bitcoin's price hikes. Now you see why it makes total sense. Bottom line, the halving, we don't really care. Yes, it impacts the supply and therefore the price of Bitcoin. But in essence, this could be a completely transparent mechanism if the quantity of Bitcoin decreased gradually with each block. So who's to say that Bitcoin will see another expansion phase? Well, nothing. Nothing guarantees that of now. And that's precisely why the market isn't jumping on it like they're desperate. However, if one of the GA Crypto team members invested over half of his wealth in Bitcoin mining, it's because he believes that he has a fair shot of success. The real question to ask is, when is the next monetary debasement phase for the dollar? If you take a long-term view, the Fed's interest rates will show you the periods of economic expansion and contraction. During the Trente Glorieuses, or the Glorious 30, a period of intense economic growth in France from 1945 to 1975, interest rates increased because growth was on the rise. This makes sense since Maurice Allais, a Nobel Prize winner in economics and a currency specialist, demonstrated that long-term interest rates mirror the long-term growth of a country. The simple reason for this is that markets are efficient and in fact do not expect more than what a country can provide. Clearly, we can observe the economic growth phase from 1955 to 1980 and the structural decline in growth from 1980 to the present. But this tells us something else quite intriguing. If interest rates rise above a country's structural growth, then it's a downfall. In fact, on this chart, you can see that any sharp increase in interest rates is followed by periods of economic recession, highlighted in gray. It's now becoming clearer why. When rates exceed long-term growth, the economy crashes because it can't keep up. So if we zoom in on the chart a bit, it's obvious that a gray bar is missing today. Indeed, structurally, one could argue that rates shouldn't exceed, let's say, 2 or 3% as a trend. But currently, they're over 5%, and the Fed is still discussing raising rates further. So logically, we should anticipate what has been happening for the past 70 years, a recession. So how have the Fed and ECB been fighting recessions for the past 20 years? By debasing currency, since debts are too high to endure rate hikes for too long. Therefore, I'm pretty confident about Bitcoin's value, and to be frank, the team has even begun implementing aggressive strategies as the timing feels right. For this, we turn to Trackcoin and DeFi to boost returns while minimizing losses if by chance we're wrong. For one of the members of the team, Richard, the goal isn't merely to outperform Bitcoin, but also to avoid significant losses if Bitcoin suddenly drops to $10,000, which is a possibility in itself. To be very explicit, and to show that the GA Crypto team is not bluffing, you can see on this address that Richard has staked 15 ethers with the Lido protocol, earning roughly 4% in Ether via pooled staking. He's also put 15 ethers into Rocket Pool to do the same thing, but with a protocol different from Lido, diversifying his risk. Next, he took his deposit proofs and pasted them into a protocol called Gravita, allowing him to mint about $25,000 of GRAI, a dollar-backed stablecoin. With this GRAI, he purchased just under 1 Bitcoin. That's where Trackcoin comes into play. Since its launch, Trackcoin has matched Bitcoin in performance terms. The track record is still short. Its performance may not be due to high volatility, which requires time to determine if the algorithm outperforms Bitcoin. However, a noteworthy property of Trackcoin has emerged. It excels in reducing maximum losses and volatility. During Trackcoin's existence, users have earned similarly, but they faced much smaller losses during downturns. This means Trackcoin managed to exit before dips, though it might have lagged in re-entering the market. Currently, Trackcoin is proving to be a cautious tool, and it's this caution that Richard is leveraging. When Bitcoin is in on Trackcoin, Richard buys Bitcoin with a borrowed cash, and when Bitcoin is out on Trackcoin, he sells his Bitcoin for USDC and USDT, the two biggest stablecoins in the market, which he then places with an approximate 40% yield on the swap finance protocol. So Richard is exposed to the rise of Ether plus a 4% return, and he's also exposed to the increase in Bitcoin's value. Moreover, when the market is down, he's also making a 40% yield on half the value of his ethers when the market is not performing so well. If we factor in the performance of Trackcoin while adding a return when it's out, it easily outperforms Bitcoin. It acts like a safety belt. It doesn't do everything, but it buffers you during market downturns. That's the theory anyway. Richard's placed $50,000 on this bet and intends to hold it until October 2024. So the GA Crypto team will keep you posted by then on how it all went down. And you can also track it firsthand by following this Ethereum address. But wait a second, Satoshi Nakamoto took the time to do things properly. Could it be that he roughly scheduled the halvings every 4 years to align with economic cycles, giving a boost to his creation? It's a possibility after all. This narrative I'm sharing has been repeating itself for a long time, but the mystery will likely always remain.